This conference will now be recorded.
So I put some items in course content just in case you didn't have access. I guess you all have access, and I wasted my time putting it in there. But in terms, and what I asked you to do was to make hard copies. So as we're going through, you aren't trying to flip back through documents and everything. You got the hard copy there to work with. That probably will aid in the learning process. So go ahead and make those copies. And I told you also you could go and uh, listen to some prior videos as we begin to work. Okay, so. Okay, let's look at what we are now, and we've worked on 3 systems, and we looked at data uh, based on historical records. Some of the principles won. Now we move into the course where we begin to look at the planning aspects and planning to do things. We'll measure what happens later, but we're going to plan it. In absorption costing, which the basic thing we've done before, we said direct materials, direct labor, all overhead. Those were the product costs. And then we had the variable, then we had the selling and administrative. Those were the period costs. And we did an income statement subtracting product costs and then period costs. That is going to change. So for the rest of the course, we're going to break down costs between variable and fixed. And so only the variable costs are going to be at the top of the income statement, and the fixed costs will be below. So variable costs, those are things that are going to vary with production volume, and fixed costs remain the same. Okay. So here's another chart that shows you how the statement would look. Sales less cost of goods sold gives you the gross profit, less selling and administrative variable and fixed. So we don't make that distinction. But when we go to variable costing, we look at the sales, less the variable product costs, give us the variable manufacturing margin, the variable selling and administrative expenses. This gives us our contribution margin. Then we subtract all fixed expenses, so the fixed part of manufacturing overhead and the fixed part of selling and administration to get our net income. So in general, as we go forward, raw materials and labor and selling expenses and bad debts are going to be variable. So those are going to be variable. We'll to make it simpler, we'll make all the manufacturing overhead fixed, and the selling expenses they're variable, and administrative expenses will be fixed, and interest expense will be fixed. So we'll look at that, but just begin to think in that way. And so, and here we have a little more detailed example of some assumptions on a problem worked out: absorption costing, variable costing, and how those income statements will vary. So go through and look at this, and we'll go back through it next time. But the key thing that you're going to see, if we're just doing a traditional income statement, it would be sales less the production cost of goods sold to get a gross profit, less selling and administrative expenses to get a net income. We're changing that up now, and it's sales less the variable cost of production. So just the labor, just the raw materials and labor, which vary, less the inventory that gives us the cost of goods sold and gross margin. Then we're going to take out the variable selling and administrative and overhead to get a contribution margin. So the key thing is this contribution margin, and we'll be getting to that a little bit later. But selling price less variable expenses give us the contribution margin, and then we have our fixed costs to give us the net income. So it'll differ at times, because when we have inventory, if you're using absorption costing, the manufacturing overhead fixed costs are going to be in that inventory, and it's going to be higher. But if you're using variable costing, all the manufacturing overhead is expensed that period, so none of it's in the inventory. So just look at that, review it. There are a couple study problems. I'll give you a little break because that's not the key thing. Okay, now we begin now to move in the major parts of this course. As you remember in Principles 1, your main takeaways were, I'm going to learn how to prepare financial statements, an income statement, a statement of retained earnings, and a balance sheet, and a statement of cash flow. And then we followed up on that cash flow in a little more detail this semester. Now, your takeaway from managerial accounting is not so much what we've done before, but this planning information. First of all, being able to determine break-even point. As you go through management classes, especially entrepreneurship, as you go into marketing and other classes, people will expect you to be able to calculate a break-even point, the point at which the unit sold will produce revenue minus expenses zero, break-even point. That is something that you expect to be able to work with. Okay, so that's one of the main takeaways. The second takeaway, which follows up on this break-even point, involves your project, where you're going to have to prepare budgeted financial statements. And you'll find now, if you take the entrepreneurship class, they want those financial statements. You'll need them in marketing, the top part as you work on projects. You need it in the capstone course. They expect you to be able to prepare integrated financial statements. And so we'll be on to that.
Capstone, is that like the last one? Business, the big 450 class that requires all classes to be done first?
Correct. And when it's taught to you, especially this Professor Johnny Williams, she's going to want to know, can you calculate break-even? Okay. And you can, she's going to say, y'all ain't learned nothing. Here y'all think y'all supposed to be in my course, but not any of you all, because you all going to know how to calculate a break-even. So we get into how many products do we have to sell to generate a target profit of $1 million. Okay. Let's get some terms down. We're doing this on a unit basis. Everything is one. And it's going to be good if you all can calculate unit cost. I know somebody was calculating their labor, and I think the unit cost, I think the pay rate was 15, and they could make 3 per hour. So they said the unit cost is 3 per hour. So you're going to have to be careful, because as we go forward, you'll find that if you make a mistake in your calculation of unit cost, then you're going to have some problems. So selling price, that's what we sell a product at. Then the unit variable cost. These are the costs that vary directly with the quantity sold. That's going to be your raw materials. And that's going to be your labor. That is, they're paid, they work based on how many units they're making. The fixed costs remain constant no matter what. And then I got 5 formulas in here: break even, target profit, and target loss. And I'm going to say it for the first time. You got to memorize these formulas. Now there are 3 formulas here: break even, target profit, target loss. I'm going to say it the second time. You got to memorize these formulas. And finally, for the third time, in case you weren't listening, as you go through this course, through the file, and through your project, you have to memorize these 3 formulas. There's a break-even formula, there's a target profit formula, and there's a target loss formula also. And we talked about that contribution margin income statement. Sales less variable cost gives us a contribution margin, less fixed cost gives us the net income. So let's look at an example. Let's say we have a product, we're selling computers. They cost $2,500 each. The variable cost of $1,500, the fixed cost $150,000. And so if I were calculating my contribution margin, which is an important concept, selling price less variable cost gives us the unit contribution margin. So Kayla, how many of these do I have to sell so that once I sell them, my net income will be 0? That is, I don't be breaking even.
Can you scroll back up to that formula real fast?
You don't have it memorized?
No, I don't. UCM is unit cost, right?
Mm-hmm.
And FC fixed costs divided by unit cost. Okay, scroll back down.
UCM is actually the unit contribution margin. You say unit cost.
Oh, unit contribution. Okay.
Well, let's just look at it together a little bit. And we're going to sell one computer first. So suppose I told you you were selling one computer. Selling price of that computer is $2,500. The computer cost you $1,500, and your fixed costs were $150,000. If you sold one computer, what would your income or loss look like? If you just sold one, you're selling one computer. Let me see if I can get my stuff out of here. I don't want to cut it off. So we're selling one computer, okay? And I would test students and I'd say, what would be the loss if you sold one computer? And that was the hardest thing in the world for them to calculate.
It's 150, but you gotta realize we're just starting, and I ain't had time to actually study.
No, I'm just saying that I would typically assume, okay, if you sold one computer, what would be the loss? And I wouldn't go over that. Then I put it on a test, they say, well, that's just one. And they would catch the devil with it. So let's see what will happen. If we sell one computer, we get $2,500, correct? And the variable cost of these computers we said was what? $1,500. Okay. And so the contribution margin, notice this is on a unit basis based on one, is what? $1,000. Okay, that's in that big. Now, how much were the fixed costs? Look up here and see. Our fixed costs were $150,000. And so if you sold one computer, what would it look like? What would the net income look like? $149,000. So if you were running a business and you were buying a product at $1,500, you were selling it for $2,500. Each product, the contribution margin is $1,000. So each product is contributing $1,000 to cover fixed costs. So if you sold one, you'd lose $149,000. Now, can everybody work one like that? If you sold one, oh, you can't sell one thing. Well, I go over it now, so that's why I go over it now. I say, well, let me just sell one. And that way, by selling one, all we did was we took the selling price, $2,500. We put that selling price here. We took the variable cost, $1,500. We put that here, and so the contribution margin was $1,000. And if your fixed cost, your rent, and your salaries and everything was $150, then you would lose $149,000. So the key thing is realizing that, okay, I got to sell a whole lot more to break even. So suppose, Kayla, now getting back to that question before, how many do I have to have up here in this quantity? You can help a Dawkins and Cameron. How many do I have to have up here so that when I make this little calculation, this number is going to be 0? That's break even.
Is it not 150? It's not. No, I'm not sure right now.
Wait, so
that's Dawkins. So we sold 150. What's 150 times 2,500?
Oh shoot. Well, that's not it. All right.
300,075 or 375,000. I mean.
All right, 375. And what's the variable cost going to be? 1,500 times 150. How much is that?
$225,000.
325.
What?
And so my contribution margin is what?
No, Mr. Gordon, you said
No, I said 225.
it's 225.
Excuse me. Okay. 25. So what's my contribution margin going to be now? 375 less 225 is how much?
Too much. And I was wrong. And I'm okay with that.
375 minus 225 is how much?
150,000. 150,000.
Is down herself in there? Did you have your breakfast? So the fixed cost is 150 0, 0, 0. So the net income is 0.
Oh, wait, so I was right? Shit.
You were right.
Dang.
That's bad when you know that like you're not even like on top of it like that and still get it right.
That's something as it.
Mm.
That's why I like Kayla. So, like to pick on her. So she was right. So you're speechless now, right, Kayla? You're speechless now.
No, not speechless. Just mentally tired.
Oh, okay.
I
Let's
need
look
a
at our.
nap.
So let's look at our formula. The break-even formula says I take my fixed cost and I divide it by my contribution margin. Now this is the unit contribution margin, this 1,000 right here. And so I take my fixed cost, 150, I divide it by that contribution margin, and that's going to give me the quantity every time. And so, if Emerald, you memorize this formula, then you can make this calculation if you memorize it. So if you can only memorize one,
Wait, what
memorize
does SP and VC stand for?
selling price, variable cost.
Oh, okay, cool.
So we go back over here over here on the unit side, and that's why we got the contribution margin. So whenever you want to calculate the break even, you just got to put it in this formula: fixed cost minus contribution margin. Here are the fixed costs, 150,000. The contribution margin is simply going to be selling price minus variable cost. That's contribution margin. So 150 slash 1,000. And of course, Hines is going to put this in an Excel formula for us. So for his team, which kind of makes sense a little bit. But you got to understand something there. So the formula. So yeah, you can create a formula very easily to do this, but you need to understand it and realize that you're working somewhere and they say we're looking at introducing a new product line. And the logical question is going to be, how many do we need to sell to break even? That's a logical question that comes up, marketing majors. How many do we need to sell to break even? Our marketing majors, if we cut the price on items, what kind of profit will we make if we cut the price and the quantity sold goes up by 25%? That's kind of happening all the time. Sales, every day something's put on sale. Every holiday, things are put on sale. Well, you better believe the top sales managers are going through and making a calculation and saying, if I change the selling price, what would happen? Okay. They're doing that all the time. So marketing majors, you kind of, if you're going to be off the showroom floor and in the office planning things, then this is what you plan. But, there's some people who just be on the floor selling. So Best Buy has some people just selling the TVs. And they got other people planning up there determining, okay, what should this price be? Okay. Any questions? As an aside here, I'll come up with this box over here. Suppose the company decides that they're going to have a sale, okay? And they're going to drop the selling price to $2,000, okay? The item still costs $1,500. So the question becomes, how many do you have to sell now to break even? So if we drop the selling price to $2,000, variable cost stays the same. How many do you have to sell to break even? So that's the calculation. Marketing majors, management majors who are also make it all the time. How many do we have to sell now to break even? So yeah, this is something that's used all the time. So you just gotta go and memorize these formulas, and to work with it. So how many we gotta sell now? You got to guess what was, Kayla?
Is it 300?
More or less than 150?
Oh, my bad.
Is
Is it 300?
I feel like it will be less than 150.
Come on, Kayla. If you lower the price, you gotta sell more now. So what'd you say?
Well, yeah, that's right.
I said 300.
And we
Oh,
said,
probably right. Yeah.
I put it into the formula.
put it into the formula.
Yeah, because I subtracted well, of course, you subtract the 2,000 by 1,500. I got 500. And then I divided 150,000 by 500, and I got 300.
So she's saying that if you change it, this becomes 500 now, as opposed to 1,000. So since this is 500, if you put 500 into this formula, it will be 300. And don't y'all make decisions like that at Papacitos all the time in terms of banquets and what
Oh
you
my
gonna?
goodness. Yes, we do.
I'm telling you, this is utilized. So y'all can't just go around and say, well, why are we learning this today? Their business, all the restaurants are doing this, and all the retail stores are doing this. That is, if they put they're in business to make money, and so if they lower the price on something, then they have to advertise it. So fixed costs may be up, but how many do they have to sell or break even? So this is a constant thing that we're doing. Okay. So we see that one. Now suppose that as you have on your projects, suppose the first year of your project, you're gonna lose 100,000. So the first year of your project, new business, you're gonna lose 100,000. Now this is this case where we change the selling price here. So just kind of keep that over there. But now you starting out with that project you're making, you're gonna lose $100,000. How many do you have to sell to lose 100,000? Will it be more than 150 or less than 150?
I would say like more.
Come on now.
It'd be less because we're losing product.
The Emperor was on top of this one, I tell you.
I already told you I do this with work.
So you'll take the lead on the team.
It's a team for a reason.
Yeah, your time to lead. Then you tell me the other day you just have all the confidence in the world you can do things. Didn't you tell me something like that?
No, you told me I need an internship, and I told you I have one with my job. See, I'm learning.
I don't think that was the conversation, but anyway, we have this second formula: target loss equals fixed cost minus the target loss divided by the contribution margin. So this is the second formula you're supposed to be memorizing. So how does this formula change? Break even fixed cost over contribution margin. Target loss, fixed cost minus the target loss over the contribution margin. So we're going to take the 150,000 in fixed cost. We're going to subtract that the 100,000. We're going to get 50. And we're going to divide by 1,000. I guess I might have 1 0 in here too many. Okay, so how many would we sell and lose 100,000 in? How many would we sell? What would this number be?
50.
Thank you. So what's 50 times 2,500?
$125,000.
And what's the variable cost? 1,500 times 50.
No, Mr. Boyd, I said 125.
Yeah, you're right. It's got to be less. Thank you. 125. So what's this going to be?
75,000.
75. So now on a dollar basis, that contribution margin is what?
50,000.
50,000. And if your fixed cost 150,000, you're gonna have a bottom line of 100,000. See that, Walls?
Yes, I see it.
Good. You all work on your quiz for next class period. All right. All right, so here are our high rollers in here. How many you got to sell to make $1 million? Give y'all 2 minutes to calculate that. How many you got to sell to make $1 million?
I got 1,150.
Same.
Yeah, I got the same.
So what is the magic number?
1,150.
1,150. So what's the total sales?
2,875,000.
What's our variable cost?
1,725,000.
So what's our contribution margin on dollar basis?
1,500,000.
And what's our fixed expenses?
150,000.
So does that equal $1 million?
Oh wait, no, it doesn't. Oh wait, I'm tripping. The contribution margin is 1,150,000.
Putting your numbers down. They don't be like some teams calculates one thing and put something else down. Okay. So that is what this chapter is about. There's three formulas. There are assumptions. And you simply plug in this information to work these problems out. That doesn't seem so hard, does it? But why is it hard? Nationwide, students have a lot of problems with this. Maybe it's trying to understand. So on your projects, the first year, you're going to have to tell me the quantity that will cause your project to lose $100,000. Then on the second year of your project, you're going to have to tell me how many you got to sell to break even. And then on the third year of your project, you tell me how many you're going to have to sell to make $1 million. And then on the fourth year of your project, you tell me how many you got to sell to make $2 million. So there's a year for everybody on the project to work with. So somebody is working with the $100,000 loss year. Somebody's working with the break-even year. Somebody's working with the $1 million profit. Somebody's working with the $2 million profit. And you
And
develop.
by project, do you mean the project that we're doing ourselves, the one we're coming up with?
Correct.
Okay.
So this leads. So your project now, you already know that the first year, I got to come up with a quantity that would cause me to lose $100,000. Then you're going to come up with a quantity that's going to cause you to break even. How many you got to sell? Then you got to come up with a quantity that will cause you to make $1 million. And then you got to come up with a quantity that will cause you to make $2 million. So that's what you'll be telling me 1 week from today on your project. You'll be telling me that 1 week from today. Any questions by anyone? Do we need to work another one? Can everybody handle this? Oh, everybody can handle it? Okay, good.
So we're in the class?
I'm kind of confused still.
Thank you for telling the truth there. This is, still got to keep on with class. Somebody's confused. Okay, so let's clear this out. So we're clearing everything out. And so let's change our formula. I'll just put it over here. Let's make the selling price $3,000. So our selling price is $3,000. Okay. We will keep the variable cost at $1,500. And we'll make the fixed cost $300,000. Okay. So we just changed an example. So we got a new example. Selling price $3,000. Unit variable cost $150. And the fixed cost of $300,000. Does everybody got the assumptions? All right, so everybody go fill out this chart now. I'm supposed to have my formulas memorized, so I'm gonna take them out. So everybody fill out the chart. Selling one, then you got a net income of minus 100,000. Then you got a break even of a 0. Then you're making $1 million. So Dawkins, if they sold one, what was the loss?
You said if they sold one, what was the loss on? Didn't you say like the last time it was 149,000? So like
That was,
90?
that was the last problem. We got a new one now. What's selling price?
Was it 1,500? I'm sorry, you scrolled past the assumption, so I couldn't actually take a picture of it, but yeah.
3,000 was the selling price.
Okay, 3,000.
cost, and the fixed cost for 300,000. So if we sold one, we get what? $3,000. The cost of selling one is what? So what's our contribution margin?
2.
What part are we on
Oh,
in the
but
book? I'm sorry.
1,500.
We just changed the assumptions. We
Mm-hmm.
went up here and changed these to 3,000, 1,500, and 300,000.
Okay, but like, what are we calling this? It's not process. This is variable.
This is cost volume profit analysis, CVP.
Okay,
Cost
good.
volume profit analysis.
I was just trying to find it real quick.
All right, Doc, it's moving right ahead, right along.
But why are you choosing me when you know that I'm the one that's confused about it? I just told you that I didn't know what was going on.
Help your team member out. What's going to go in this box here?
Which part?
Yeah. Mm-hmm.
So therefore, what would the net loss be if you sold just one?
Would it be 298.50? I mean 500?
Yeah. What she said. 298.
That's in 500.
So it's
Yeah.
so it's just 300,000 minus 1,500.
Mm-hmm.
Yes.
Yeah.
Oh, well, that part was easy. The other ones.
All right, let's do the break even one first. So we want to do break even. We put what? 300,000. Put a slash in here.
We need to sell 200 of them to break even.
Right here behind, what would be the contribution margin?
1,500.
It'll be the same.
So we divide 1,500 into 300,000. What do we get?
200.
100.
So this is 200, you say?
Mm-hmm.
Wait a minute.
400 sold. 200.
So,
Just 200.
okay, 200. So what's our sales?
600,000.
Variable cost?
300,000.
So the contribution margin?
300,000.
Fixed cost?
300,000.
And so as long as we don't change anything in these options, this fixed cost, we can just copy it, and as long as it's not changing, we can just paste it in. So the fixed cost is going to be 300,000 every time until we change it. Any
So
questions?
so it's basically like just 200 multiplied by like every single figure in this for this chart. Like 200 by 3,000 is 600,000, and then 200 by 1,500. So it's just like that.
Essentially by everything in column one, you're correct.
Okay, that's how I like kind of remember stuff. But
That's how you kind of remember stuff.
yeah, like if I can, that's why I'm like one of those learners that if you compute like all of the figures, I kind of like try to calculate it in my head to see if there's like a like some type of, like fixed calculation, like just like I said, it's like 200 times 3,000. If I can do it like that, then I can remember it by seeing the chart like already filled out. But the other ones that you were talking about, like, are they the same? Like, is that the same way? Like trying to find the profit to be like 1 million. Like, how does that chart fill out?
And so next time you're going to have your chart done in Excel with Excel formulas to do this for you. Okay. So you can have your formulas before you get to class or during class. And those are your individual formulas since you got to notice yourself. So Kayla, they should be able to do this by themselves. You know, do an Excel sheet and put this on an Excel sheet with their formula. Y'all
Is
said
it
y'all
teamwork or is it not teamwork?
that's not
You're
teamwork.
forcing my team members to do nothing by themselves, and we in the team.
This is not teamwork because they got to eventually pass a final exam. It's not teamwork.
Okay, so you want us to make this chart in Excel with formulas built in? All right.
And see, as we're putting it in Excel, and Doc makes a good point. Well, how does this work? Well, if you put your formulas in, then you should be able to see it better. But that's only going to happen if you put your formulas in. So you can't be using anybody else's formulas to learn, to understand what's happening.
Wouldn't they be the same formulas? I mean, I'm just saying, hypothetically.
They're kind of different way. This is a chart, and you got to do the whole chart, okay?
Yeah, no, I know.
And you're going to have your assumptions. So your assumptions are going to be on your chart. And they're going to be in what? They're going to be in boxes. And so you're going to be coming from your assumptions and write your formulas to get this done. So depends on how you write it, but there are the different ways to write the formulas.
Yeah.
And so Dawkins was saying, write some formulas and see if you can get that to work for these that we're working with now. But formulas can vary depending on how you write them. You just do formulas so you understand it. So everybody doing their own formula so they understand it. Okay. Formulas are helpful, but you got to, you still got to be able to how to write things in the formula. So what's our quantity to lose 100,000? What is our quantity to lose 100,000?
It's not really like a whole number. It's
But
not
sometimes
100. Do you want to just round it up?
don't have whole numbers, just be within $100. So you're around and everything.
It's a 133.
Okay. So someone says it's 133. So what's 133 times 3,000?
399,999.
So that rounds out to be what?
400,000.
The variable cost?
200,000.
And therefore, the contribution margin was what?
Also 200,000.
And the net income is 100. I meant loss is 100. How many for $1 million?
Asada, you got this one.
I just got throw me under the bus
Come
like
on, Miss
that.
Dawkins.
Right. I'm
I mean,
like,
like a
okay,
million.
so So my thing is the quantity sold part at the top. That's the. I was trying to figure out how you got 133. So like, what did you divide to get that? Because once I get that part, I can just like do.
Okay, you
Well,
start with the fixed cost and your goal, the target profit. So for like let's say for the million, you would do 300,000 plus a million, and then you would divide that by your contribution margin.
Margin. Okay. Okay.
So we always
So
start fixed cost. That's why I got to memorize the formula. So Dawkins, I let you slide today, but I expect you to have these formulas memorized on next class period. So fixed cost 300,000 plus the profit.
yeah, that's a 1,300,000.
Yep,
Mm-hmm.
plus a million. And of course, we'll put this in parentheses. So if you're, and you see, so if you're writing these formulas and everything to do this, hopefully, we'll see if that will help. But you got to write a formula. Hopefully you'll be doing that to calculate it. And then we're going to have what, a slash. And then the CM, in this case, we said was what? 1,500.
1,500. It came out to like 866.66, but I guess like we just
Right.
use 867 or 860, like how.
But what is 867? What's the sales on 867?
Okay, hold on. Is it like 2,000,000? 2,600,000?
I need more confidence in your voice, sis.
I'm sorry, but I'm new to this. I think it's I'm just okay, fine. 2,600,000, period. Period.
I can assume y'all could multiply now. So what's the variable cost?
Okay. 1,300,000.
Go to the word on it. What's our contribution margin?
1,300,000. Because it's it's the same figure.
Million down here. So you got three formulas. And then this calculation of this one column, which gives you your information to extend across. So this should not be that hard.
Okay. Thank you, everybody, for y'all assistance in helping me.
We
'Cause
got
I was
you.
really confused.
Okay. Well, that's, sometimes it's there, but you have to think of what's happening. Now here's a sample worked out problem. And on this sample worked out problem, as we begin to move towards your product, that's a simple one. We got a selling price. We won't worry about these collections and everything, but here we go. Raw materials, ink, 1 cartridge per book. Raw materials, paper, 2 reams. Those are variable costs. We don't have to worry about this. Direct labor paid. Team 4, you think y'all can handle this and get this correct? As I tease them a little bit. Then you're only concerned the total manufacturing overhead, that's fixed. Don't worry about the depreciation yet. The selling expenses are 10% of sales. So that's going to be a variable cost. Administrative expense 175. Don't worry about the depreciation. Then you purchase some equipment with the annual interest being 25. That's fixed. And of course, principal, you don't worry about that at this point. is only this interest that you're concerned about. Then it says determine the sales quantity for year one based on a target loss of 100,000, year two break even, year three based on a target profit of $1 million. So this is the calculation you got to go through. So it's not going to be, you just got one fixed cost and one variable cost. So when you're making something, we're at a selling price of 100. Then we have to calculate the direct materials, direct labor, selling expense, and bad debts to get our contribution margin. So some of y'all need to go practice on calculating labor again, whether you multiply or divide. That was a grading. Then our fixed expenses, not one, but three, 200, 175, and 25. So total fixed expenses, 400. So when we get to this year one, for the loss will be 100, it's going to be 400 total fixed expenses. When we add them up, they 400 minus the 100 divided by contribution margin, 60. That contribution margin, selling price, minus 40 in variable expenses give us a contribution margin of 60. So this is how we begin to look with it, okay? Then when we get to the break even, it's about 667 units. And then to make $1 million is 23,333. So no, it's not like, you got one number, but you're going to have a variety of numbers. You have to go in here and find them. But this is a good example. And as you work in your example, as well as your project, it's going to look just like this. So your project is going to have direct materials, it's going to have direct labor, it's going to have selling expenses, it's going to have bad debt. It's going to look exactly like this. So that's why we're working it that way. Then you're going to have three fixed expenses on your project, not one, but three. Manufacturing overhead, administrative expense, and interest expense. So this is leading directly into the numbers in your project. Then next Tuesday, you're going to be showing me these numbers for your project. And we're going to talk about how we get there next time. Due next time is for all teams that are probably on 14-1. So every team's got to do 14-1. Then teams 1 through 3 will be 14-2. And in working this, each team member should make the calculation separate, then you compare. Because eventually on your quiz, which could happen next class period, you got to work it by yourself. So right now, when you do 14-2, all team members work it separately and compare. Shouldn't take that long to do this. That's teams 1 through 3. 4, 5, and 6, you got study problem 14-3. And then teams 7, 8, and 9, you got study problem 14-4. So in working these study problems, I have more here than I thought. We'll just stop with those. Okay, so in working these study problems, each team member should make the calculation separate. And I think on the handout, I tell you that you're paying the accountants $50,000. So I want a new break even if you pay the accountant $50,000. So this should be on all of those in Blackboard, if not just add it. So if you hire an accountant for $50,000, how does that affect your break-even number? So we should be finishing this on Thursday. So I told you to make your copies. You should have your copies made. And you're definitely going to need them made for when we go to the master budget. Okay, so we'll save that for next time. So you're just completing this table. So eventually, everybody gonna have a quiz where they got to complete this table. Everybody will have a quiz. You know, I do those multiple quizzes. Some quizzes will be harder than others. I'll make sure I give Emerald a hard one, so she's an expert at this.